Well, the global economic picture remains as uncertain as it did a month ago, perhaps even more so. Again, yesterday we saw investors ducking out of equities back into US treasuries and gold after more data out of the US cast a shadow over a recovery in the world's largest economy. So what's the outlook for markets and what should investors be doing? With their views, I'm joined by Richard Robinson, lead manager at Ashburton's European Equity Fund, Paolo Senatore from RMB Private Bank. Gents, thanks very much for coming in today. Richard, uncertain times, what are you telling your clients?
Yeah, well, I think the whole world is actually really focused on whether it's the media or just generally sentiment is focused on whether we're going to have a jobless recovery. You know, it's looking at the consumer, it wants a consumer-led recovery, and perhaps we're going to get something else. I mean, you know, 2003, Germany recovered by investing in fixed assets, improving efficiencies, and then the pickup in the unemployment market improved. So, you know, if we look at that, you know, capex is being increased, and if we look at a consumer that is reticent to spend, then I think, you know, the one thing companies need to do is increase efficiencies, and that can help, you know, subcomponent manufacturers and the guys who manufacture machinery. So I think it's this drive into efficiency that maybe helps.
Is there any room to further improve efficiencies, Paolo, though? Because we've seen those US earnings in particular coming out for the past year. In every quarter, they've got cost cutting, revenue not really growing at the top line, lots of cost cutting going through. Are there more efficiencies to be had?
Earnings definitely have been driven by this cost cutting and companies becoming more efficient. I think the risk lies ultimately, there's a point to which you can do that, and we do know in the Western world, of course, that there's a situation where the consumer ultimately may come under some pressure. Bear in mind the government's pulling back and cutting their own expenditure. So there is this play, of course, between the two. And one can't forget, though, that the one side that might be supportive of the global economy is the Chinese economies, for example. They're becoming a bigger part of the global world and therefore play a bigger part. And that might just provide the bit of balance that we need to pull us through a slow recovery phase. Of course, the efficiency gains will start to come to an end. It has to.
Paolo, do we have too much hope pinned on China? Of course, we have a state visit to China next week, lots of companies going there with President Jacob Zuma, government ministers as well. Are we pinning too much on China at this stage?
Well, we're pinning a lot, of course, and it's a big trading partner for South Africa, as we've noted, and becoming a bigger player in the globe. If China were to slow down, has slowed down, but it's still a big number, of course, its growth rates. If it were to slow down drastically, of course, it's going to impact the globe. And that puts valuation levels in play. If you look at the earnings from South Africa, it's a fairly high PER market, 17 thereabout, and of course it's driven largely by resource counters on our all-share index. Those are providing, as we see now, really strong earnings growth coming through. Of course, if that were to stop, it would leave our market a little vulnerable because of a relatively high valuation level. And our market's fairly valued relative, historically speaking, to Western world stock markets as well. So it really does need the earnings to come through. And a large part of that earnings is on global demand for commodities.
Richard, sitting in London or in the UK, how are you viewing the South African markets? How do you view South African equities? Do they look a little bit expensive for your liking?
Well, I mean, we're running a European fund. The main access that we'll get is through the resource stocks to South Africa. But and those sort of trends, you know, like South Africa, we are looking at what's happening in China, etc. So, I mean, that's really how we approach things. I mean, the way that we're looking at things is we're trying to find stocks that will do well in the face of a deleveraging consumer. You know, we're buying stocks like Viscofan, who make sausage skin. So with the idea sausage skin, yeah. So
is there a company called Sausage Skin?
Viscofan. Oh. So Viscofan. So the idea that people are buying less steak and more sausages, for example, or we're looking at ways that companies can help governments increase efficiencies. You know, the ones that will do well out of the cost of Medicare.
And that's for people with a healthier diet that don't eat sausages.
Yeah, absolutely. Yes, but we also play the diabetic companies as well. So all sorts of good.
So you're really looking at, I mean, if you are looking at a jobless recovery, if you are looking at a consumer under pressure going forward, you want companies that can do well in the face of that. So quite defensive companies as well, I should imagine.
Fairly defensive, but maybe with good structural stories happening. You know, salmon farming companies, you know, salmon farmers in Norway, when you're losing 30% of the world's salmon off the coast of Chile, for example, because of disease. You know, these companies, their exports will increase. across to the US. So you're looking at structural issues that are occurring. And also, as I said, companies that will help governments either raise tax revenues, so again, resource stocks, because mines that were potentially had environmental issues are actually getting signed off because governments become less pious because they need to increase tax revenues and oil companies.
Of course, Paolo, until a few weeks ago, we were seeing foreign capital continuing to flow into our equity markets and really boosting already high prices, particularly in sectors like the retail sector, maybe some of the banks. That seems to have dried up a bit at this stage. Do you think that is off the table for the time being? Do you think they're still looking for opportunities in our market?
I think in the short term, the equity flows is probably going to settle. Once again, I bring it back to valuation levels and the fact that globally we're starting to see mixed economic data coming through, which is leading the equity investor to be a little bit more concerned. That I don't think plays really in the bond market, of course, because he's still after the interest rate differential and that gap is still fairly wide. And so we continue to see strong flows into our bond market supporting the rand. So whilst from an investment perspective we'll say structurally the rand is probably quite strong, you should take advantage of it, you've probably got time to take advantage of the strong rand.
Richard, how wide is your investment universe sitting in Europe at the moment?
How wide? Well, it's got to be any company that's listed in the major sort of European countries.
And what are their valuations looking like? Because I know those markets have been pretty oversold. Are they looking attractive at the moment?
Certainly are, yes. I mean, profitability is very, very strong. And then you have, so the valuations are pretty decent. And then in countries like Germany, it's not all doom and gloom. 18-year low unemployment rates, record high imports, record high exports. So they had the strongest growth, I think, in 19 quarters. So it's looking, there are pockets of strength. So,
and do you have to be quite selective with the markets? And you mentioned Germany. I saw yesterday the Bundesbank saying they expect growth of 3% in Germany this year, and that's pretty solid growth for an economy of that size.
Absolutely. No, I think you have got to be fairly selective in where you are investing. I think you've got to move away from benchmark hugging and invest in the areas of strength. And as Germany saw in 2003, they did have a jobless recovery, and countries like that are very, very hot on the high end of industrials, the machinery, should do well out of this global drive for efficiency because you can't increase your prices.
Well, should South African investors sitting here at the moment, already with the rand around 730, so looking pretty strong at these levels, should they be looking for opportunities in these markets?
Yeah, I think so. And of course, it might go a little bit further. You mentioned Germany, a strong economy, a good example of a well-run economy. But South African investors traditionally always investing in the UK, Europe, maybe needs to broaden a little bit. Asia, a strong growth region, maybe there's opportunities in those markets as well.
And what's the valuations like there at the moment, though?
Well, of course, if you look into the Asian funds, they've had this huge run. So once again, the strong growth rates of the Asian economies has been played out to some degree from a current pricing. But longer term, it's hard to ignore that the fact that China, India, Brazil will play major components of global growth, when we start looking 5-10 years down the line.
Well, you, Richard, were talking about a lot of investments in food stocks. Of course, food needs fertilizer usually. BHP Billiton making a hostile bid for potash. A good move for them. Is this a company you think they're being innovative? They're looking for new future revenue sources, and of course, food is going to be a major source going forward.
Yeah, and that's actually one of the sides. Potash is one of the sides. The application of potash since 2008, because of the lack of funding, a lot of farmers struggle to put potash on the fields. So they underutilize potash they've done it for the last 2 or 3 years. And actually it comes to a crunch point. You have to start applying that stuff, and so the supply going forward, there should be a good window there. And that's why they were probably, in some views, possibly overpaying. But as a strategic move, I think it probably does make sense.
What do you think, Paolo? A strategic move for BHP Billiton? Because it really is moving away from their comfort zone, isn't it?
It's moving away from their comfort zone, but I think as a commodity, it has huge potential going forward. And if you look at the yields that are coming out of Western world farming communities to what is coming out of, for example, we go back to Asia, huge potential for the development of this kind of industry in those markets, and I think that's a picture they're taking on longer term. And of course right now the possibility of raising the funds for the acquisition is probably opportune as well.
Richard, are you fully invested in equities at the moment? Are you keeping a little bit of cash back for any future growth in the markets, or perhaps sticking it into gold?
Well, we've moved, I would say we've moved the sort of beta down in the fund. So we've moved into some selective, more defensive types of areas, but we try to stay fully invested. There are moments where, if we have cash on our books, then we don't just throw it at the market, and we'll wait for the right opportunity. But we we feel that's our investors' decision as to how much cash they want to keep.
What are you advising investors at the moment, Paolo?
Well, we're going offshore in a pretty neutral, balanced way. In other words, for a benchmark that a client might put together in terms of his longer-term equity positioning, let's say that's 50, we're pretty much hugging that at the moment. So we're not taking excessive risk relative to a client's mandate at this point in time. So it's a fairly neutral, which implies you have a fair pocket of cash on the side, which of course needs to wait for the opportunity, and one hopes there's a fair chance that the markets might be a little bit lower. If they are down 10% or so, that would be the opportunity to move more cash into the equity markets.
Gents, we have to leave it there. Thank you very much for your insights today.